So, you're thinking of moving to the South Carolina Lowcountry and you need to get a mortgage, and you're wondering, okay, do I call my guy here in New York, New Jersey, Ohio, Pennsylvania, California, wherever, or do I reach out to somebody here in the South Carolina Lowcountry? Well, that's exactly what we're going to talk about today. I'm going to interview one of my trusted advisors and talk about the benefits of working with a local lender here in the South Carolina Lowcountry. So don't go anywhere. Let's get started. Do you want to know everything there is to know about the South Carolina Lowcountry, whether it's Bluffton, Beaufort, Hilton Head Island, or Jasper County? Then subscribe below and tap that bell for notifications so you'll be the first to know about the current market here in the South Carolina Lowcountry. My name is David Simcox, host of Lowcountry Lifestyles and a local realtor. I get calls and emails every day from people just like you and you and you and you looking to make their move here to the South Carolina Lowcountry, and I absolutely love it. So whether you're making your move in 3 days or 3 months, give me a call, shoot me a text, send me an email, or book a Zoom call, all in the description below, so I can help you find your Lowcountry lifestyle. In today's video, I will be interviewing one of my top advisors, one of my local lenders who is my go-to guy, to basically tell you guys the benefits of working with a local lender. So without further ado, let's move on and talk to Aaron. All right, guys. So on today's video, I've got Aaron Benton with me, and Aaron is very special to me because he makes me look really good. He is my preferred lender. I do work with several, but he's my go-to guy. And the reason is not just because he's a nice guy and he's friendly, but he's really, in my opinion, the best in the business, in this market anyway. And so thank you for being on the video today, Aaron.
Appreciate you having me.
And thank you for always taking such good care of my customers. And a lot of times people are moving here from New York, New Jersey, Ohio, Pennsylvania, California, wherever it is, and everybody seems to have their lender back home. And they say, hey, I've got pre-qualified, I've got this letter from this guy back in Ohio or wherever, but they don't realize the value and the benefit of working with a local lender. And there are some real benefits to that, but I'm not going to go into all that. I'm going to let you talk a little bit about that, and then maybe I'll fill in a few things along the way. So without further ado, Aaron Benton.
Thanks, David. Appreciate it. Essentially, we're very fortunate in this area, the Lowcountry, if you will, South Carolina, Georgia. We have a lot of nuances that, of course, you can get pre-qualified because you can talk about interest rates, kind of our interest rates. In terms of one of the big factors here is taxes.
Right.
There's a significant difference in South Carolina between a primary tax rate and a non-primary tax rate.
Okay.
So many times when you're talking to your individual up north, they're gonna look on Zillow per se, and they're gonna say, okay, well, I see that the seller is paying X. Well, one of the first questions that we talk about is occupancy,
right,
and a plan there, because how I start the loan is based on occupancy, which is going to directly affect that tax number.
Okay.
So there is a 4% rate for a primary owner based on the millage.
Yeah.
There's also, for the non-primary, it's 6%.
Okay.
The catch there is that the non-primary people also pay a school tax.
Gotcha.
In addition to the 6% millage. So what does that ultimately end up being? It means that taxes for a non-primary resident is about 2.5 times greater than that of a primary.
Okay.
Not necessarily a deal killer, but something that you want to be understanding of, so you're not caught off guard or by surprise. So one of the things with this piece is that taxes each year are assessed by the county based on occupancy or designation of the person living there January 1st. And what I mean by that is if I'm buying a house and I'm buying it from somebody who it is not their primary residence, then the county taxes are going to say that's being taxed at the higher rate. Well, I'm not going to qualify you at the higher rate because I know it's going to be your primary.
Right.
And essentially, when you come to the Lowcountry, you're going to apply for this 4% primary exemption, assuming it's going to be your primary.
Right.
And you're always going to get this 4% as long as you can show that you filed your taxes in the state of South Carolina, you've moved over your driver's license, and then there's a couple additional documents that the county makes you handle.
They want you to live here for what, 6 months and a day to be primary?
That's what they say. Yeah, when it comes down to what Beaufort County or Jasper County or counties in South Carolina are going to deem as primary,
Yeah.
I leave that up to the county and the client to have the conversation about. When I structure a loan, it's based on intent. Okay. So when a client tells me, hey, I'm moving here, my family's moving here, I have a job, that can be a primary resident. That's primary tax rate. If I have a client who says that they can work remotely and my family's moving here, that's primary tax rate. It's when this is going to be our second home, we might short-term rent it out, we might long-term rent it out. Those are all fashions of not being your primary resident, and those would incur the higher tax rate, if you will.
So it's not really, it's based on millage rate, so it's not like 4% of the price or 6% of the price. I know in Beaufort County at least, it's about, if it's your primary residence, around 0.5% of the purchase price. Would you say that's accurate?
That's correct, absolutely.
So if they're buying a $500,000 house, it's about $2,500 a year in taxes.
Mm-hmm. It's a fair statement.
Okay. And then the other thing that we have here that a lot of people don't have is 80-90% of the homes in Bluffton are in these planned communities, and Hilton Head's very similar, and they have HOA fees, what a lot of people call POA fees. That's the Property Owner Association fees. So how does that figure into the mortgage and what you qualify for?
Absolutely. So when we talk about qualifying, you take into consideration principal, interest, taxes, insurance, sometimes mortgage insurance.
Right.
We also have to take into consideration this HOA, this Homeowners Association fee. And depending on the neighborhood, those are vastly different.
Right.
I mean, I have seen them range from $600 a year all the way up to about $23,000 a year.
Yeah.
So that is something, when we talk about dollars leaving your pocket on a monthly basis,
Yeah.
That is absolutely taken into consideration in terms of qualification.
The bank looks at that.
Absolutely. The other thing that you as the client want to know is some of these neighborhoods have initiation or transfer fees, kind of welcome hello gifts,
Yeah.
where they're charging you a fee to get into the neighborhood.
Right.
And not that they're bad, it certainly takes care of the nice amenities that you have, potentially the gate, but at the same time, when you're looking for cash to close, it's nice to know that, okay, I have set aside maybe 0.25% of the purchase price, or I've set aside $1,000, because that's the transfer fee or initiation
That's
fee.
part of your closing costs.
Absolutely.
And I see a lot of them now, if you're looking at Hampton Hall, Hampton Lake, a lot of the private clubs, Berkeley, Belfair, Colleton, I mean, it could be as much as $70,000 up front. So, I mean, it might only be 0.25% of the purchase price, but it could be a significant amount of cash outlay.
Absolutely. And that's just one of the things when we go through our breakdown, there's really two numbers that people are concerned about. It's what's my monthly payment going to be,
Yep.
and the HOA plays a role in that, and what is my upfront cost.
Okay.
And as you said, the HOA transfer fee, that is an upfront cost due at the table, and it's just something that you certainly want to be aware of.
Okay. So another thing that comes into play here, if somebody's coming from, Ohio, they're typically not going to have like flood insurance. And for the most part, Bluffton, I don't see a lot in flood zones. Maybe Hilton Head a little more, Beaufort even more than that. But flood insurance, how much does that affect the financing aspect of what you do?
Absolutely. So one of the things to understand is that FEMA has different kind of flood zones. So if you're in a flood zone A, it's mandatory that you have flood insurance. And also that means that you must have flood insurance that the lender cares about.
Right.
So that coming in from the lens of what is my monthly payment going to be, if you are in a flood zone A, then I'm absolutely going to have to take into consideration what that flood cost will be. Now, if you're in a flood zone, say X or C, those are not FEMA mandated flood zones, which means you don't need to have flood insurance. However, if you obtain it, it's just going to be separate of the mortgage. I'm not going to take that into consideration in my monthly calculation for you because the flood insurance at that point is optional.
It's not going to make you not qualify for a loan.
That's correct. But you would be able to get that through it's optional. Just like maybe a club membership is optional, right? Maybe being a member of the gym is optional. Having that flood insurance is optional. The other thing to consider with flood insurance is insurance as whole has gone up. So one of the main things that we have been focusing on is having the purchaser assume the flood policy.
Okay.
So as insurance has gone up, basically sellers have a flood policy that was locked in at a rate maybe a year, 2, 3 years ago, if you will, and our buyer can now assume that flood policy, and it's a much better premium than going out in today's market and seeing what the flood policy could be. So that's just a way to ultimately save a couple bucks.
Okay. And so moving back over to the Hilton Head side of things, I have a lot of people, and we just had this recently. We were talking to someone, if you remember, and they wanted to buy a condo, and they had a pre-qualification letter from their lender back home. And I told them, listen, I'm not trying to direct you in any particular direction, but I want to make sure your lender back home understands whether they can actually truly lend on this property. There are some real nuances when it comes to condos.
Yeah, condos is a whole different animal in itself. And what happened was Fannie Mae and Freddie Mac, they passed some legislation or guidance, if you will, 2021, March of 2021. And that was focused around transitivity was the word that they used. And what they noticed was that many individuals were using condos as kind of similar to these hotel-like attributes, if you will. And what defines hotel-like attributes? Well, if there are timeshares in there, if there is a front desk, if there is maybe a restaurant on site, things that have these hotel-like attributes, Fannie Mae and Freddie Mac don't want to lend in there. Why is that a big deal? Because when you can't deliver a loan as a lender to Fannie Mae or Freddie Mac, your pool of buyers, if you will, in the secondary market is much less. What does that mean? That means that the interest rate is going to be about 2% higher than those of condominiums that Fannie Mae and Freddie Mac will lend in.
Is that basically a warrantable versus an unwarrantable condo? Is that the terminology?
The technical term is warrantable versus non-warrantable.
Okay.
Essentially, in our world, I'll have individuals like yourself, David. You'll give me a call and you'll say, "Hey, can my client lend in here, or can you lend in here as a warrantable?" Meaning Fannie Mae and Freddie Mac will lend in here. And fortunately, we have a database because I live here, and the company live, breathe, walk, understand what all of these guidelines mean, and I can give you an answer right on the front end saying, yes, this is something that Fannie Mae and Freddie Mac will take, or they won't. In which case, we can have that conversation just like I did with your client of the rate is going to be 2%, roughly 2% higher than maybe what you would have thought.
Okay. So again, a lot of times I let people know it's really good if you're coming from somewhere outside of this area to work with a local lender. And part of that from a real estate perspective is it really helps in the negotiation as well. Because this guy here, if you ask any realtor around town, he's got an incredible reputation. He's one of the top 1% or?
Top 1% in the country, yeah.
Top 1% in the country. So the realtors around here know this guy, and they know that when he puts his name next to something, it's as good as gold. So it makes your offer, believe it or not, look stronger if they've got 3 offers on a property and one has Aaron Benton's pre-qualification letter and the other 2 are from xyzmortgage.com and the other one is from somewhere out in California who's their local lender. They're naturally going to trust this guy's pre-qualification letter because they know that at some point in the next month they're going to have to sit next to this guy at a restaurant here locally, and if he didn't tell them the truth or he the deal didn't come together, he's got a local reputation to protect. Absolutely. So I think that's a big benefit. What are some of the other benefits to working with a local lender in your opinion?
Well, I think you hit the nail right on the head. There's obviously the reputation, the idea of you're moving. I'm going to see the seller, the listing agent, the buyer's agent around town. And I think they're people will come to me a lot of times and they'll just ask, all right, I work with my real estate agent, but what are your personal opinions? And I can tell them my story of why I moved here, what I like about it, and why I've continued to live here for 9 years.
Yeah.
I mean, I moved here from Buffalo, New York, fell in love with the area, met my wife here. I'm not going anywhere. I absolutely love it. I think this area has a tremendous amount to offer. So I can give that really upfront, honest, third-party opinion of why I really like the area. But I can also talk to them about the numbers and utilize my connections, if you will. I think a lot of times the non-local lender, if you will, which no fault to them, they just don't know the area like I do because it's my backyard. We're able to tap into condo associations and ask them questions and get answers on insurance questions and talk to attorneys. So any kind of issue that could potentially snowball and blow, we're able to address those issues right at the word go and get our answers back so much quicker. And that's just all relationship based.
Right. And another thing I've noticed from working with you, this has just been my experience, you really seem to think outside the box. So it's not just crunching the numbers and making them fit in a formula, but there's been a lot of times, especially because we have a lot of retirees working here. And so a lot of times they're going through a life transition where they're moving, they're selling this house they've been in for 30 years, and they're having to figure out like, okay, do I liquidate my retirement account? Do I liquidate my 401k? Do I pay cash for this? Does it make sense to leave that money? Do I set up distributions in order to make the payments on this new mortgage? And I really feel like just in working with you that you have, it's not just a mortgage loan officer, you really are like a financial advisor of sorts.
Yeah, I appreciate that. So the beauty of being the mortgage loan officer, if you will, is the client, whether they want to or not, in order to obtain a loan, they have to pretty much give over most of the information that, you know, your accountant might not necessarily know all the ins and outs of you. Your financial advisor might not know all the ins and outs of you. Not necessarily like licensed in those areas, but I do have the benefit of seeing this whole overarching view of what your life looks like, at least at that moment. Mm-hmm. And the good news is that you surround yourself with quality people. And I've said it to people, maybe you want to go talk to your financial advisor about this, because this is something that I noticed. Now, I'm not licensed financial advisor, but that's something that I would give you advice on. I'm not a tax advisor, but I understand capital gains and things like that, where I can just talk to you on a real level of, hey, does that really make the most sense? Maybe you want to talk to your CPA about that topic, because I don't want you coming back to me in April and saying, well, you never mentioned that there was a huge tax liability that was going to come across. Right. We just had the client the other day that closed, and they were going to liquidate a large portion of their retirement. And I said, you know, that sounds really, that's a short-term, fits a short-term need. But when Uncle Sam comes around in April and says you probably owe him about $150,000 in taxes, I probably would advise that you talk to your accountant to see if that makes sense. I have a plan for you, but I want you to run it by them as well, because the goal is to have everybody on the same page.
Sounds good. All right. So again, I'm vouching for this guy. I've got a long track record with him. It all started out, I was at another company, and he was blowing up my phone for like several months saying, let me just take you to lunch. Let me take you to lunch. And I'm glad we finally did. I think we went to Java Burrito the first time.
We did.
And I'm glad we did, because he's been a really good part of what I consider like my team, people that I rely on, my professional network. If they want to reach out to you, you want to give your phone number and email?
Best way to get a hold of me is my cell phone. It's 843-505-5623. My email is aaron.benton@movement.com. And my website is aibenton.com.
Okay, I've got a hard question for you, and I didn't tell you this one was coming, so I'm going to surprise you.
Go ahead.
All right. So if somebody comes to you and their lender back home or an online lender has given them a rate lower than maybe what you've given them, what would be your advice to them? Or what do you typically do in that situation? Because I know rates can be all over the place. Sometimes they throw on some extra closing costs so they can buy the rate down. But, how do you typically handle that?
So people will shop for rates, and I think the first thing you want to talk to people about is what is the rate without paying points, because that is the market rate without you coming out of pocket with additional. So many times when they say, hey, I got a rate from, like you said, xyz.com, I'll say, can I take a peek at the loan estimate? I mean, there have been times when I have seen the individual, they had said to me, I got a rate that's 0.75%, 0.5% lower than my rate, and I quickly pointed out, well, but you're paying $5,000 to get that. I can actually do that, and I can actually get you a lower rate if you want to pay $5,000. So what I pride myself on, because again, in the community, is there is no smoke and mirrors. I will give you the facts, the honest number. Now, if you go out and you shop and for rate, then that is certainly your choice. And what I would say is, I ask that you bring it back, because there are ways that we can make things happen. I'm going to give you my best every time, because I have no benefit not to give you my best. But as you already alluded, the market can change. So if I give you a rate today, my rate could slightly be different tomorrow or the next day. And it's not because, it's just because the market moved. And like my rate would move, as would the other individuals that you spoke to as well.
Yeah.
So rate shopping, I understand. But at the same time, I would say give it a fair shot, because rate is one portion of buying a house. And I understand it makes a big difference. It means, it can mean thousands of dollars over a period of time. But at the same time, what also matters is that you get the house, you close on time, and then you have a good experience. And with our local knowledge, I think we're able to kind of tie all that together and give you a loan estimate, because by law, you have to get a loan estimate 3 days after you are under contract. And that loan estimate, basically every single time, is within hundreds of dollars, which is a really nice testament to us, in my opinion, because we're dealing with hundreds of thousands of dollars sometimes. So to be that close, we take a lot of pride in that. You know what you're going to pay, basically at contract, and it's going to mirror what you have to bring to the table, so that you're not caught off guard.
Sounds good. All right, and for what it's worth, I would pay an extra 0.1% just to work with you.
But you don't have to. We'll get you.
All right. Well, thank you for being on the video today, Aaron. And you guys really, if you want, reach out to him. He left his phone number and email on here. Rewind it. Go back to that spot if you need to. But really appreciate it. And thank you for being a part of what makes me successful.
Thank you, David. Thanks for having me. And work with this guy. He will beat you up. He's pretty strong.
Bye, guys. All right. Thank you so much for staying till the end of the video. I hope you found something interesting or learned something in today's video. And again, if you want to stay up to date with the latest in the South Carolina Lowcountry, be sure and like, subscribe, and tap that bell for notifications, so you'll be the first to know about the current market here. And if I can help you find your Lowcountry lifestyle, give me a call, shoot me a text, send me an email, or book a Zoom call. All in the description below. Again, my name is David Simcox, host of Lowcountry Lifestyles and a local realtor, and it has been an absolute pleasure spending time with you again today.